Hey traders, this is Blake Morrow with Trader Summit, and with me I have Jim Welsh from Macro Tides. As we always meet up on Fridays, so it seems. Jim, how are you? How's the markets been treating you this week? A lot of volatility.
Knock on wood, most of the things that you and I have talked about the last 2-3 weeks have really come to fruition. So I'm glad I'm having the opportunity to kind of review some of that today.
Yeah, actually, you know, the thing about, I mean, you look at the dollar. We talked a lot about the euro and a bounce in the euro, and did it bounce? I mean, the weekly candle on what the euro is going to look like by the end of the week, you know, trading above 114, you know, from, you know, the beginning of the week, we were trading what, below 112, 1150. Yeah. I mean, that's a huge move. I'm sure there's a lot of reasons why. Let's unpack that move first. And I'm going to pull up your chart of the euro while we're doing this. So what do you make of the euro move that we're seeing, and how do you reconcile that move, and is it warranted, Jim?
Well, let's a couple steps back. First of all, I backed into the idea that the euro should be bought when we were speaking last Friday, based on the dollar chart, because to me it looked like the dollar was peaking near that 97.50 that I had talked about the prior 2 weeks. Yeah, and that completed 5 up. We were going to see a decline in the dollar. Well, the euro's 57.6% of the dollar index. So if the dollar is going to pull back, the only way that happens is if the euro rallies. And on the euro chart, when we were speaking, I said, yeah, it looks like you got 5 down on the euro. You can see the RSI divergence in that bottom panel where it was making a lower low, and yet the RSI was comfortably above 30. And so it's rallied up to the wave 4 of lesser degree, which is a natural place, that middle horizontal line where you would expect some resistance to come in. The lower horizontal line is it possible that it retraces 50% of this move up, pulls back to about 113? Yeah. My take though is I think it's likely then to subsequently move up toward the 116 level. And then you'd have 2 legs up being relatively equal. So
well, when you say that, I mean, you say that, you know, the euro trading up to 116, that's going to imply that the dollar index has a lot lower levels to go. You know, 94.50 had been a really big pivot for the dollar index. So you're thinking we can drop well below that.
I think you can see 93.50. Again, you know, what I've written about was looking at sentiment, which had gotten very positive of the dollar. You know, people think, oh, the dollar has to go because the Fed's tightening policy. Right. No, it doesn't work that way. What we saw this week is the ECB for the first time gave some hints that they might stop buying bonds before the end of the year, with an outside chance of a rate increase. And that's really what it, you know, ignited the euro. But interesting, the chart pattern, the technical analysis part of it was already there. The news just came in after the euro had already rebounded, and then it really, you know, gave it
well, that, you know, it's going to be really interesting. I think the 115 level in the euro, based on today's data. By the way, we'll talk a little bit of, let's talk a little bit about that before we get into the next couple of charts. Well, actually, I guess we could probably do it right now. You know, you have the 30-year yield, and obviously yields are breaking higher today with the jobs data. So what do you make of that? I mean, you know, we got this great jobs report. 30-year yields are, you know, pushing higher. 10-year as well. What's going on here?
Yeah. Well, again, from a chart standpoint, all for, you know, a number of weeks and going back really last few months, my expectation was that the Treasury yields were going to be ramping higher in the first quarter as the Fed scaled back its buying. The Treasury had to increase its supply and issuance. And so at a minimum, I thought the 30-year would get above 219. We touched about that last week, and it rallied from about 208 and 222, I think, is the high. I put this chart together a little bit earlier. 225 would be the next price target, I think, based on this. So you can see it's starting to get overbought. The bottom panel, you know, shows the intermediate trend is up, but it's getting near 70, which indicates oversold or overbought. So I think there's the potential, Blake, that we could see a spike higher here, and then that there's a rally coming maybe in the Treasury market as people start to put more stock that the Fed is going to be raising rates, will slow the economy. More importantly, they're acting to address the problem of inflation. And at some point in time, if the bond market starts to have confidence that, gee, the Fed actually is going to do what needs to be done, you could see rates actually come down for a period of time. So I'm looking at this being kind of the end move, unless we see an acceleration through 225. I think this is the end of the move up from the 167.8 low that we saw back in early December.
All right. Well, that's fair enough. And so we think you're thinking yields might move a little bit higher, but they're going to start to pull back a little bit. And you know, what we've seen in response in the stock market is we've had, you know, the sell off in equities. Now, as we are talking right now, it's a Friday. You know, the S&P is near its lows of the session, but we had great jobs data. So Jim, what's up with good jobs data, weak stocks? How's that work? How's that work?
Well, it's interesting. Last Friday in our conversation towards the end of it, I made a comment that, you know, for a very long time, the stock market has been feeding off whether it was good news or bad news. It was interpreted as being good news for equities, because good news was, hey, great, the economy's doing better. That's good for earnings. Bad news, oh, the Fed's not going to do anything with policy. And my comment was, we're finally at that place, Blake, that good news isn't going to help the market. You know, bad news is bad and good news isn't going to help. And to me, the employment report and the market's reaction confirms that we're at that place where it doesn't matter what the news is. There's selling pressure happening. So the wave pattern I've been talking about, we discussed it. I thought at a minimum, the S&P could get up to 45.20. It exceeded that. I won't go through the detail, but the 45.95 was another price target. And I think we're in wave 5 going down. And I think next week could be pretty ugly, because people are coming to realize the Fed is serious. They're going to be worried about a 50 basis point hike in March, although I don't think that's going to happen. But good news is not good news anymore. And I think there's a potential that the S&P could decline. You know, if this pattern is right, it'll happen next week.
Wow.
Below 200, maybe down to 4,100. So I think we're setting up for, you know, kind of a mini kibosh.
well, you're scaring the crap out of me, Jim. But let me ask you this. You know, you've got, you know, potentially the stock market moving lower here and selling off, retesting these lows for it to you know, end wave 4, going to wave 5. Is that correct?
That is correct.
Okay. So the next chart,
much more protracted rally, I think, that will follow, you know, once this thing is unwound.
Okay. Well, the next chart you have up. And so I guess the next question I was going to ask you is, you know, what's that do to gold? Because gold's trapped. It seems like it's just trapped in this range. What do we do with gold? I mean, I want to buy it, but it's, you know, rejecting at 1850. It looks like it's being supported around 1780. What do we do here with gold?
Well, you're right. It's in a big triangle, as you can kind of see, where the lows are higher and the highs are lower. It's struggling at 1815-ish, which to me was one of the resistance areas. Once we broke below that last week, I got stopped out on a long position. I think you might get a little bit more bounce, maybe back up towards that 1835 area. But I think the probabilities are rising, Blake, that we'll see gold make a trip down to that lower trend line, which is in the low 1740s. You know, you've got obviously the Fed tightening. The Bank of England raised their policy rate this week. ECB is giving hints that they're going to be pulling back. I just don't think if you have a tide of central banks removing accommodation, that's going to, you know, give gold a big lift, given that it didn't really do and perform as I thought it would as inflation kept ramping up. And that was my big thing 6-8 months ago. Inflation is going to be not transitory, more persistent. That ought to be good for gold. And for whatever reason, technically, you can see it's remained trapped in this triangle.
It has been, but, you know, my argument to you, Jim, would be, you know, gold is a, you know, historically, it's an inflation hedge. And you could argue and say, you know, gold was 6 months ahead of the inflation curve, if you will. But what we're doing is we're just consolidating these gains right now. And if inflation is going to be continuously, you know, persistently high, let's say, or, you know, leveling off at a much higher level, you know, will gold stay elevated as well? I mean, and maybe gold's going to be that leading indicator to let us know what's happening with inflation 6-10 months down the road.
12 months from now, potentially. Okay, it's a good point that you raised. If you look at the RSI, it's like middling right around 50.
Yeah, it's back to mid-range, right? It's worked off all the overbought conditions, right?
Yeah. So, I mean, to me, to your point, if we see a drop down below 1750 in gold, the RSI is going to be close to 30. And to me, that would be, okay, let's buy it. We're near support line and so forth. The reverse is getting above 1850 on a close. In other words, closing above that upper downtrend line would then constitute a breakout. So to me, it's like you're in the middle of no man's land. The RSI is not oversold. It's kind of like, let's see what the market does.
So, yeah. So I was just going to say, we can argue pretty much any point at this stage. And, and the market's really just telling us, let it develop versus you trying to assume, what's going to happen. Right.
That sums it up quite nicely.
All right. Well, Jim, I'll tell you what, it's been, it's always enlightening meeting with you every week. But let me ask you this, as far as what you have on the radar, is there anything else that you're seeing that you're like, hey, I really got, like for me, I was looking at cryptos this morning and, you got Bitcoin kind of taking out a multi-week trend line, lower trend line. You got Ethereum back above 2,800. That's kind of what's on my radar thinking, I don't know if I really want to be short risk. Is there anything on your radar right now that you're saying, yeah?
Well, what I'm looking at is emerging market ETFs. And EEM specific. I'm looking at South Korea. And to me, those are setting up for what I think could be a good trading low. But, why I don't think we're there yet is if I'm right about the S&P dropping below 4,200, it's hard not to think that EEM and the South Korea ETF aren't going to get caught up in that selling pressure. So if you look at charts, I've got some price levels that I've been working with. We'll talk about that a little bit next week, if indeed we get this sell-off. But I just think those things have underperformed relative to the S&P, and it's the old regression to the mean. Yeah, that gap is going to close. And more importantly, central banks in emerging markets raised rates over 100 times last year. Brazil's gone from 2% to 10.75, 10 and a quarter, something like that. I think those banks are closer to hitting the pause button because they started way ahead of the Fed. And the economy is going to rebound, both here and globally, because Omicron's coming down. And I think people all over the world, they just want to get back to normal. So anyway, that's what's on my radar.
I'm glad you brought that up. And don't get me all excited. I might actually venture out and buy the Argentinian peso. Just kidding, everybody. Just kidding. Hey, so let me ask you this: if I'm a trader looking at you, going, man, I like what this guy says. How do I follow you?
Macrotides.com, and I do a weekly technical review and a monthly Macro Tides letter, which really looks more at the fundamental and the bigger picture. And I think it's important to combine short-term, obviously intermediate term, as well as fundamental with technical analysis. And that's what I try to do with both those publications.
Well, that's great to know, Jim. And I'll tell you what, if you guys are watching Jim on YouTube right now, make sure you give him a thumbs up and say, I really like your content. That's telling him you really like it. And also you could get to his profile on the Traders Summit site. Click that link, and then that'll take you right to Macro Tides. And then also make sure you subscribe to this channel. It's free. Not only this content from Jim, but all the other contributors we bring on each and every week. Jim, I want to thank you so much for being with us today. Have a great weekend, and we'll see you next Friday.
Thank you. Next week could be a lot of fun, Blake.
All right. We're looking forward to it.
So rest up.
Have a great one.
Yep.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.